morning, everybody. It's really an honor and a pleasure to be here. And Gabe, thanks very much for the invite and thinking of us. I'd be remiss if I didn't congratulate you all on the merger. You know, from an outsider's perspective, it looks like it makes a lot of sense. In different geographies, different industry emphasis, and so congratulations from us. As I look down the list of attendees, it's nice to see a lot of old friends. We really thank you for all of the referrals and contact we've had with one another over the years. For those of you who don't know me, I'm the co-founder of Woolery Wind. Frank Woolery and I started Woolery Wind 23 years ago, I'm happy to say. We've grown from an idea on a sheet of paper to about 650 clients nationwide. We have clients in every state, and we focus on financial institutions only. Most of you will think of us, a lot of you will think of us in the credit union space rather than the bank space, but the truth is that we have more bank clients than we have credit union clients. And in fact, we have 66 publicly traded bank clients. We have about 42 of the top 100 credit unions. And I think importantly for this presentation, you should know that we work with 5 of the top SBA loan originators in the U.S. So, we have a very sophisticated client base in that space. In addition to focusing on financial institutions only, we focus on 4 business lines only. So we don't want to be everything to everyone. We want to have a very deep understanding of the services that we offer. So we offer ALM, CECL, M&A, and servicing. And I'll spend just a minute or two describing why this interrelationship is important. Because we do ALM and we do non-maturity market studies, non-maturity deposit studies, we have a very informed opinion about core deposit intangible when we go about a merger. Because we do CECL, and by the way, I can't wait to do that deck because our models in back testing over the last couple of years are 95% accurate. So compare that to the other vendors that you're seeing in the marketplace. Because we do CECL, then our credit mark in an M&A transaction is highly informed as well. We have about 450 or more servicing clients, so we're very first in the prepayment behavior of residential mortgage loans. Again, that informs our ALM modeling, and it informs our M&A modeling. So all of it, there's a synergy that arises from doing 4 things only and doing them very well. I'm going to turn it over to Eric and Annalise here shortly, but before I do, when we were looking at the schedule and thinking about the deck, it made sense to us to do CECL before we do validations, that we can talk about kind of all the modeling and background of things ahead of time before we just finish it off with validations. We also made a presenter change on validations. We put our big dogs on it, so it's going to be Frank Woolery and Mike Tessier doing that presentation. And so we just, sorry for the scheduling change, but we just thought it was important to do it in that order and put our big dogs on it. It's really appropriate that we're leading with mortgage banking because that's where the firm started, and so I think it's apt. We also have a time-tested deck here, so I hope you'll enjoy it. Eric and I have presented this deck many times to the FFIEC Capital Markets Group, among others. And so this deck, I assure you, has been thoroughly vetted by industry experts, including the regulators. So without further ado, I'm going to turn it over to Eric and Annalise. They co-manage our servicing line of business, and so it's appropriate that they would co-present today. Thanks, everybody.
All right. Thanks, Doug. Go over a few housekeeping items before we get started on the actual presentation. For those of you that are hoping or wanting to earn 1.5 hours of continuing education credit for this, these are the requirements that you'll need to fulfill. To earn full credit, you'll need to attend at least 75 minutes of today's session. Additionally, we'll be posting 6 polling questions throughout the webinar. We are not planning to announce when the polling questions will be coming up, but they'll be spread throughout the presentation. You must answer at least 5 of these 6 polling questions to earn full credit. And please note that you do not need to answer these polling questions correctly. Simply answering them is sufficient. At the end of the webinar, a survey will launch. While you are not required to complete the survey to earn CPE credit, we truly value any feedback that you have. And your CPE certificate will be sent to the email address that you registered with sometime next week. All right, so now on to the exciting world of mortgage banking derivatives, mortgage servicing rights, and SBA 7A gain on sale calculations. So there's a number of topics that we're going to touch on. We're going to touch on the mortgage marketplace in general. We're going to go into great detail, some might say excruciating detail, on mortgage banking derivatives. We'll touch on the mortgage servicing marketplace. Again, we'll go into great detail on the mortgage servicing rights, and then we'll touch on SBA 7A marketplace, and we'll do some SBA 7A gain on sale calculations. And as Doug mentioned, these are all business lines where we really we believe we do a really good job, and I think our clients believe we do a really good job on valuing these items. Myself, Eric Knockin, I've been with the firm for 20 years, and Annalise.
Employee number 1.
And Annalise has been with the firm she just celebrated her 10-year anniversary just last week. All right, mortgage marketplace. So we've got 2 slides, and I'm going to use the laser pointer piece, and hopefully this works well, for these 2 slides, because these are really kind of interesting slides. When we look back in history at the mortgage market and we look at 2004 through early 2007, we really see the significant increase in non-conforming mortgages. We also see a significant increase, or a significant portion of the originations being ARM loans. As those of you that lived through that period well know, there was the housing bubble that burst, much due to the ARM loans, the pay option ARMs, the various schemes, if you will, that mortgage originators pushed through and were, what's the term that I want to use? The loans that they were originating, the fraud, yeah, the NINA, the no income, no asset loans and things like that. Obviously, come 2008, we saw the housing bubble burst, and we saw those non-conforming originations drop back down to quote unquote more normalized levels with the significant tightening of underwriting standards that took place. Jump ahead to 2020 when we saw COVID hit, and we saw record low mortgage rates, some 30-year conventional mortgages even sub 3%. We saw a huge origination boom, significant refinance volume. And then as we came out of COVID into 2022 and 2023 and beyond, we saw significant declines in mortgage originations. So these are all originations in dollars. I'm going to jump to the next slide, and we're going to look at percentages. And so we really saw, again, over half of the loans originated in 2005 and 2006 were non-conforming, which is, when you think back, it's just shocking that was allowed to occur. And over half the loans were ARM loans. Coming out of that bubble, we did see, really strong origination in the refinance area, and then a real strong move back to conforming conventional originations. And again, when we look at 2020, over 50% refi volume. Lots of mortgage originators made a ton of money in 2020 and 2021. And now we've really seen that refinance volume dry up, and originations drop pretty substantially. So when we look at the Mortgage Bankers Association forecast, we do see these are MBA numbers versus inside mortgage numbers. So we have a little bit different numbers here in 2020 and 2021 from origination volumes, but we see that same significant decline as we moved out of the COVID low interest rate as rates rose. Now, MBA, if you look at this regularly, they're pretty notorious for always showing some level of growth in their originations, but they really do show a decent comeback in originations in 2025 with some decent growth at 15% in 2026, and then relatively flat in 2027 from projection standpoint. Loan production by channel. This is an interesting chart because through the housing bubble, we really saw kind of about a third between retail originations, correspondent originations, and broker-based originations. Once we hit that housing bubble, we see the broker originations really tail off until just recently when they've started to creep back up. And we saw retail originations really fill the gap because of those tighter underwriting standards. It was just easier for banks and credit unions to originate loans internally. And now what we've seen here in the last couple of years, as that refi boom that we saw in 2020 and 2021, we really saw retail originations peak at just over 60%. We've started to see them tail off because in general, retail originations, they don't tend to be as aggressive from an origination standpoint as you'll sometimes see the correspondents and the brokers be from that perspective. Here we've got the top 30 lenders in 2024 and compared to 2023. So United Wholesale Mortgage has been the top originator the last 2 years, Rocket Mortgage number 2. Specifically, we included the top 20 here. The reason why we wanted to do that is if you jump down to number 19, you'll see that Navy Federal Credit Union, they're the only credit union on the list, and they have a market share of right around 1%. Another interesting thing that you'll see here is we've labeled the type of institution that are originating loans. So PNB is a publicly traded non-bank. NB is just a privately owned non-bank, and then anything blank is a bank or a credit union. So we've really seen over the last 10 to 15 years, we've seen the non-banks really increase their market share on the origination side. And when we get to the servicing marketplace, we'll see similar things. We used to see Wells Fargo being one of the top originators. Obviously, they've had some restrictions placed on them from a growth perspective that were just recently relieved from the regulators. But we've seen them fall down to number 5 in the last number of years. Mortgage held on bank balance sheets. So mortgages are one of the main assets that banks hold on their balance sheets, and you can see over the past 7 years or so, the mortgages held on the balance sheets have ranged between 24 and 26.5, 27%. One of the things that we've really seen since the interest rate rise in 2021 and late 2021 and 2022 was these unrealized losses for loans that are held for sale. We've seen huge increases in unrealized losses, and on the bank merger and acquisition side, that's one of the items that's really slowed bank M&A. And so as we start to see these losses come back a little bit and either be realized losses or just with rates moving the right direction, we're hoping that bank M&A will start to pick up again a little bit. So we're gonna dive into mortgage banking derivatives. So mortgage banking derivatives, there's really 3 very good interagency, or 2 very good interagency advisories and 1 handbook that the OCC comptroller put out that touch on mortgage banking derivatives. And as you can tell, there haven't been a lot of changes in the rules, considering we're referencing interagency advisories back to 2023 and 2025. But slightly more recent, 11 years ago, the OCC Comptroller's Handbook on Mortgage Banking is a very good and very comprehensive write-up on mortgage banking derivatives. So if you have insomnia at some point, feel free to take a look at that. That'll probably cure that insomnia pretty quickly. So the interagency advisory provides guidance on accounting and reporting for commitments to originate mortgage loans that will be held for resale and sell, mortgage loans and it addresses institutions that sell mortgage loans under mandatory and best effort sale contracts. Interest rate lock commitments. This one's really interesting. So interest rate locking commitments on mortgage loans that will be held for resale are derivatives, and that's a key point. So to the extent that a bank or a credit union is originating a mortgage loan to hold on their balance sheet, that is not a derivative. So even if they've locked in the interest rate with that borrower, they could scope that loan out of any mortgage banking derivative valuation that they need to perform. Commitments held to investment are generally not derivatives, so they don't need to value those. So
other types of loans.
Or other types of loans, correct. Lock-ins for fixed rate loans. So basically, if it's a fixed rate mortgage, that is an IRLC. If it's an adjustable rate mortgage, also an IRLC, and commitments, with floating rates. So as part of the valuation components, or what really goes into valuing an interest rate lock-in commitment, the key components are the loan amount, the interest rate. Generally, you're going to be looking at loans that have an interest rate above the market rate. They're going to be selling for a premium. If for some reason the loan is being originated at a lower than market rate, that would be sold at a discount. The price of the loan at the valuation date, the value of the servicing asset, or if they're selling the loan servicing release, the value of the service release premium, whether or not the institution is charging the borrower any discount points, or if there's any lender credits or anything like that, and then direct origination fees and costs. Now we're going to go through a number of examples here, and we're going to do a one loan example on how an IRLC is valued, how that valuation fluctuates through market movements and other items. And then we're also going to use this same loan as we talk about mandatory and best efforts commitments and loans held for sale. So we've got a $250,000 principal balance. The price of the borrower at lock-in is par or 100. So in other words, they're not paying any discount points to lower the interest rate on the loan. We're not applying any lender credits for closing costs or anything like that. This is just a straight up $250,000 loan funded at $250,000. The borrower is locked in an interest rate of 6.75%. A market interest rate for a par loan in this instance is 6.375. So we're making the assumption that the loan is worth 101.5, or they could sell the loan at 101.5 at origination. The value of the servicing is just under 1 point, and you'll see this. This is a sample value of a servicing asset that you'll see throughout the MSR section as well. So we tried to keep everything in line throughout the presentation. And the projected origination costs are 1% or $2,500. All right, so we got a lot going on this page, so we'll take a little bit of time to walk through this. As we said, at inception, everything is just as it was on the previous page. So with a 101.5 price, the value of servicing getting added to that, 1% origination being reduced from that, we're left with a value of the interest rate lock at 1.49% or $3,732. One thing that needs to be incorporated into the value of an interest rate lock commitment is a pull-through percentage. We haven't touched on that yet, so I'll address it here. Not every loan that gets locked with a borrower is going to close. And so from a valuation perspective, we know that if this loan closes, the value is $3,732, but there's uncertainty in that. And so we want to apply a pull-through percentage. What's the expectation that this loan will actually come through and close? And we've used a little bit of an extreme example here, a pretty low pull-through percentage of 30%. So we multiply our value by 30%, and we're left with an interest rate lock-in value of $1,120. So let's say a week later, rates increase by 50 basis points. So now the market interest rate is 6.875, and you're selling a 6.75% loan into that market. Well, now the market's saying, well, I don't want that loan because it's under market price, so I'm only going to give you 99.5 instead of the 101.5 that I would have given you a week ago. Simplified example that I'll touch on here in a minute, but we're assuming servicing value doesn't change. We haven't done any more work, so we're not reducing the origination costs. Now all of a sudden we've got a loss of 0.51% or $1,268 loss times our 30% pull through. We have a net loss of $380 overall, and so the value record that we need to make, or the change, the impact to the income statement is now a negative $1,500 because we need to go from the $1,120 asset to a $380 loss. That's a $1,500 journal entry that needs to get recorded. Next step, no change in the mortgage rates, but the loan has been through processing. So at this point now we say, okay, well, we've basically absorbed half of the origination costs that we assumed, so we're going to knock that down to, whoops, sorry about that, knock that down to 50 basis points. And now we're basically break even at this point. We got a 1 basis point loss. However, our pull-through percentage is now going to increase because this loan is closer to to being closed than it was before, and we know that it's been approved, or it hasn't been approved yet, but it's been through processing, so we know everything's on track. So now our loss is $11, so we make an adjusting entry of $370 to bring our balance sheet item to $11. Now, here's the good stuff. Rates drop 100 basis points. Well, now I'm selling a 6.75% interest rate loan into a 5.875 market. Now, all of a sudden, I get to earn 103.5 because the market's willing to buy that higher interest rate loan at a higher price. My servicing value stays the same. My origination costs stay the same. My value overall increases to roughly 4%, just under $10,000. My 60% pull through. I've got a $6,000 entry to make on the balance sheet and income statement. Now the loan is moved to approved status. We're going to reduce our costs further by down to 25 basis points, so we're up to 4.25. Our pull-through percent also increases to 80%, increasing the value recorded by 2,500. And then finally, the loan closes. We've gone through all our origination costs. We've got an $11,000 gain on the overall value of the interest rate lock commitment. Our pull-through is 100 because the loan's closed, and so we make our 2746 journal entry at close. So that was a very, very simplified example because changes in the interest rates will also impact the change of the servicing asset. We didn't make those changes through that example. The other thing is pull-through assumptions were very simplified in that example. If rates drop 100 basis points and all of a sudden my interest rate is 50 basis points above the market, I'm probably not going to close on that loan. I'm going to go back to the lender and say, hey, can you get me a better rate? I know rates have declined. Or I'm going to just walk away from that application and go to another institution if my potential lender won't drop that interest rate. So factors affecting pull-through and the hedge. Obviously, market interest rates, that's the big one. We just touched on that. As interest rates fluctuate up and down, if rates go up and I've got a locked interest rate, my pull-through percentage is most likely going to go up because I'm going to say, well, I'm locked in at 675. Now in the marketplace, I can't get a rate under 7.25. I'm definitely going to do all that I can to get that loan closed and make sure I can get that 6.75% interest rate. Conversely, if rates drop to 6.25, my pull-through is probably going to drop pretty substantially because I'm going to want that lower interest rate. Type of origination, retail versus wholesale. Generally, retail originators have better pull-through than wholesale originators. It's not always the case, but in general, that's what we've seen from a market perspective. Length of the lock. So how long is that lock in place for? If it's a 30-day lock, the pull-through percentage is probably going to be pretty high. If it's a 90 or 120-day lock, that's a lot longer period for interest rates to move and really put those pull-through rates at risk. Purpose of the loan, is it a purchase loan or is it a refinance loan? Obviously, if it's a purchase loan, there's a very, very strong likelihood that that loan's going to close unless something happens with the purchase itself. A refinance, on the other hand, it's a lot easier to dip your toe in the water. Maybe I'll refinance, maybe I won't, things like that. But yeah, so generally we see much stronger pull-through percentages for purchase than we do in refinance, except in 2020 and 2021 when everyone and their brother was refinancing into at a minimum sub 4% 30-year mortgage rates, or moving from a 30-year to a 15-year and holding their payment basically the same, things like that. Then you see very, very strong pull-throughs on refi loans. Type of loan, fixed or variable. Again, fixed rate loans, it's going to be more in the line of what interest rates are doing. Variable loans, there's a little bit, if you have a short, if it's a short-term hybrid, maybe you're not too concerned if rates drop a little bit of getting that lower rate, because at some point your interest rate's going to come down with it anyway. And then processing status of the loan. We did indicate that in our example, but a loan in approval status is much more likely to close than a loan in application status. So when institutions are selling loans in the secondary market, they're generally selling either using a mandatory delivery, a best efforts delivery, or a master agreement. We don't see a lot of master agreements. Those are generally really large institutions. But mandatory commitments are essentially an institution will deliver a certain amount of loans to an investor at a specified price on or before a specified date. Now, the interesting thing with mandatory commitments is there is a pair-off fee that is required. So if I take out $1 million commitment with Fannie Mae or Freddie Mac or Federal Home Loan Bank, and if I cannot fulfill that commitment, then I need to pair out of that commitment. And that's me essentially buying my way out, or if rates have moved in the right direction, Fannie Mae or Freddie Mac may actually have to cut a check to me for me to not use the remaining commitment. Mandatory commitments under the GAAP rules are considered to be a derivative. And we see examples of mandatory commitments through Fannie Mae, Freddie Mac cash window, MBS TBAs, that's the to be announced, that's what TBA stands for, and then MBS assignment of trades. So cash versus MBS pricing components. On the cash price, you've got your commitment price, the interest rate, and sometimes that's a range of interest rates. Like I may take out a commitment with Fannie Mae where I can deliver a range of interest rates into this commitment anywhere from say 6.5% up to 7%, and the prices may vary depending on what the interest rate on that loan is within that commitment. The type of loan, is it a fixed rate? Is it a floating rate or adjustable rate? The loan term, generally we see, all 30-year loans get lumped together. 15-year loans are generally priced into a separate commitment, things like that. There are generally loan level price adjusters for things like FICO score, LTV. Is it a second home, or is it what's the other thing that I had in my head? I just lost it. Investor, yep. And then servicing. Are you selling it servicing retained? Are you selling it servicing released? If you're selling it servicing retained, you should be then you're doing that all on your own. If you're selling it servicing released, you've got an SRP that gets included in the price of the loan sale. MBS components. You've got a market price, you've got a guarantee fee, so that's generally somewhere in the 50 to 90 basis point range now, depending on what investor you're selling to. You've got buy ups and buy downs, so if you're selling a loan with a lower interest rate into a higher interest rate coupon or vice versa, you can do buy ups and buy downs. And there are other pooling considerations that we'll sometimes see come into play with MBS pricing. So as I mentioned before, mandatory delivery commitments are derivatives under GAAP. The reason why, the derivative has a specific underlying, so the specified price, There requires little to no initial net investment. It has a notional amount, so what's the principal amount of the loan, or what's the principal the amount of the agreement? And it requires or permits net settlement by paying a pair-off fee based on then current market prices. And as I mentioned, it is a derivative. It should be valued. It should be recorded on the balance sheet and income statement. Best effort commitments are a little bit different. An institution commits to deliver an individual loan of a specified principal amount and quality to an investor if the loan underlying the borrower closes. That's kind of the key differentiator here, if the borrower closes. Best efforts commitments are generally not considered a derivative until the loan closes because it doesn't meet net settlement criteria. So in a mortgage banking derivatives valuation, we do generally value best efforts delivery commitments, but they are not required to be recorded by the institution, and we'll touch on that here in a few slides. The result of the change is the best efforts contracts will not offset the change in the value of the IRLC unless fair value is elected. So you don't have to record the asset, but if you don't, or I should say the asset or the liability, but if you don't have a hedge against the fluctuations in your interest rate lock commitment. Yeah, so that's I touched on the fourth one without reading it, which is totally fine. So now we've got a value, the same scenario here. This is the opposite. So this is our hedge against the interest rate lock commitment. This is the value of the forward loan sales commitment. We've got our $250,000 loan, all the same criteria. We've got our servicing value. However, on the forward loan sales commitment, we don't have the origination costs incorporated. So we've got a net value of 102, which at inception is essentially valued at 0. So there's no entry to be made at inception. But when rates increase, we're locked in at a price of 101.5, but now we would sell that loan at 99.5. Value of the servicing is unchanged. So we have a 2-point gain in our forward loan sales commitment. So we had a 2-point loss in our interest rate lock commitment. Now we've got a 2-point gain in our value of the forward loan sales commitment. Once the loan has been processed, again, our pull-through percentage is the only thing that changed because we don't have any origination costs. So now our $1,500 asset previously increases to $3,000. We have a $1,500 entry. Now rates drop by 100 basis points. So in the forward loan sales commitment, this is a bad thing. But as long as you've elected fair value, if you look at the IRLC example and the forward loan sales commitment example together, you'll see the value recorded essentially, or at least helping to offset each other as you move through the examples. So now we switch to a $5,000 total loss with a 60% pull through, $3,000 loss. We've got a $6,000 reversal on the balance sheet and the income statement. And then these last two are basically just pulling through the increased pull through percentage as we move through the approved process and the close process. So it is important for institutions that want that stability on the income statement to elect fair value if they're selling using best efforts commitments. Netting of derivatives for reporting purposes. Net gains and losses of individual derivative commitments only under certain circumstances. So generally only under the legal right of offset. So what we're saying here is if an institution has gains in their mandatory commitments and losses in other mandatory commitments, those can be recorded as one entry. but you want your interest rate locking commitments and your mandatory commitments to essentially all be valued and reported separately. So within the mandatory or within the forward sales commitments and within the IRLCs, the gains and losses can be netted, but you don't net the IRLCs together with the mandatory or with the best efforts commitments when recording them on the balance sheet. Closed loans held for sale. So this is kind of the third piece when it comes to valuing a mortgage banking derivative. Loans that are held for sale are reported at the lower of cost or market unless fair value is elected. And again, similar to your best efforts commitment, an institution will want to elect fair value if they want to hedge against the fluctuation of the mandatory commitment that's associated with that loan being held for sale. Last example here, once the loan has closed, we've got our $11,000 gain. While it's sitting on the balance sheet, if rates increase by 50 basis points, we're going to lose that 2 points of value. So we're going to have the recorded loss of $5,000 down to the 62.32 gain. If rates drop by 100 basis points from there, we get the $10,000 reversal there. When the loan sells, you reverse that $10,000 because now you're just recording the asset. And again, one thing to think about is you've got your mandatory commitment that is moving in the opposite direction here. So you've got it hedged. Essentially what you're doing is recording that loan sale value, but you've just got one side going up, one side going down. Once you reverse those out and you book the loan sale, it makes things stable, if you will. And then last slide here, we've just got an example of a secondary marketing position for a very sophisticated originator. So someone that is going through the OAS, doing a very sophisticated market analysis on their locked pipeline, their closed pipeline. They're looking at their delta. They're looking at fall in, fall out ratios, things like that. This is a very small snippet of what would be a very, very complex analysis. One thing I didn't mention at the start that I should have when I was going through the CPE, if anybody has any questions throughout this presentation, please put them in the question box and we will be sure to answer them. With that said, we'll pause for a moment here. If anyone has any questions, feel free to enter them into the chat and we will get those answered. Additionally, we will be launching the next poll question at this time. And now I'm going to turn it over to Annalise to touch on mortgage servicing marketplace.
Next, diving into the mortgage servicing marketplace, we will take a look at mortgage-backed securities. As we can see, banks hold a larger share of servicing of mortgage-backed securities as compared to credit unions. However, beyond banks and credit unions, non-banks hold the majority at over 60%, and this portion has continued to grow over the last few years. The top 5 servicers in the industry hold over a third of all servicing, and the top 100 hold over 90%. Looking at the top servicers in the marketplace, Chase has remained at the top over the last year with nearly 7% market share. Wells Fargo announced an exit from servicing, which is noted by its portfolio decrease of nearly $67 billion in the last year alone. On the flip side, Mr. Cooper and Freedom Mortgage have increased notably by $135 billion and $103 billion respectively. Additionally, Mr. Cooper and Rocket Mortgage recently announced merger intentions, which will result in them moving to the #1 place with $1 trillion in servicing. Jumping all the way down to number 24, we find our first credit union, Navy Federal, with $94 billion or 70 basis points of market share. And lastly, related to the mortgage servicing marketplace, we're going to take a look at delinquency rates. As you can see here, FHA loans have continued to have higher delinquencies as compared to conventional loans and VA loans. Especially during the COVID-19 pandemic, FHA loan delinquency rates increased substantially more than VA or conventional mortgages. While delinquencies across all loan types has recovered since the COVID-19 pandemic, there was an uptick in FHA delinquencies near the end of 2024. However, they have since recovered slightly here in Q1 2025, but continue to be a point of concern in the marketplace. Conventional loans are reflecting considerably low delinquency rates, just over 2%, even slightly lower than what we saw before the COVID-19 pandemic. And VA loans, while not as dramatic in delinquencies as FHA loans, also tend to have higher delinquency rates than conventional mortgages. With that, we'll launch our third polling question before moving into mortgage servicing rights valuations.
All right, diving into mortgage servicing rights. So there's common interagency advisories related to mortgage servicing rights. They often require comprehensive documentation of the valuation process. Really, these advisories are to ensure safety and soundness in the marketplace. So the valuation must be based on reasonable and supportable market assumptions, and changes to those assumptions should be documented and approved. It's also important to compare assumptions being used to actual results. So this can be done through back testing. For example, prepayment speeds are commonly back tested throughout time. And additionally, use appropriate amortization and recognize impairment in a timely manner. So this would be at the proper respective reporting periods when electing the amortization method, obviously. With valuing servicing rights, there are commonly level 2 inputs, so observable inputs. However, we do view discount rates as a level 3 input that is corroborated. And because of the weak link in the chain theory, we view MSR assets as a level 3 asset. So when thinking about the valuation of retained mortgage servicing rights, they are a modified interest only strip. So unlike a bond, prepayments cease all future earnings and there's no return of principal. Because of this risk, discount rates are often higher for servicing than other investments. And residential mortgages and SBA loans are the focus of today's presentation. However, there are many types of underlying loans that can be sold servicing retained, such as commercial, vehicle, ag loans. And because of the unique characteristics of these loans related to service fees, terms, the cost to service them, the value of servicing rights can vary significantly based on the type of loan. When thinking about valuing mortgage servicing rights, the loan amount is important because the service fee percentage is based off of the outstanding balance of the loan. And as I mentioned, it can vary based on the type of loan as well as investor. And then to offset the service fee revenue, you would often incorporate a cost to service, and this should be a market cost assumption. While an institution's internal costs are important from an economic value, when valuing for GAAP, you really want to use market assumptions throughout the valuation. With the expected life of the loan, that will be impacted based on prepayments and the loan term itself. Prepayments are the most volatile assumption and have the biggest impact, which we will look at an example on this in later slides. As I mentioned, delinquency rates for conventional mortgages has remained relatively low, even coming out of the COVID-19 pandemic, due to forbearance deferral programs helping borrowers maintain their loans. And in addition to modeling delinquency rates, also incorporating foreclosure losses, which can vary depending on if the loan is recourse versus non-recourse. For example, the Federal Home Loan Bank offers limited recourse programs through the MPF 125 or MPF Original program. They also offer non-recourse loans through the MPF Extra program. And full recourse sales are rare, if any, because they don't meet true sale requirements. The next assumption to consider, ancillary income. So this could be thought of as late fees, cross-sell revenue, for example, buy saver plans or life insurance. And float income, that is assumed to be earned on both principal and interest payments and escrow payments. P&I payments could be held anywhere from 1 day to over a month. Whereas escrow payments, insurance is typically remitted annually, and taxes could be remitted as frequently as quarterly, semi-annually, or annually. And so because escrow payments are held much longer than P&I payments, the float revenue generated from escrow is much greater, and therefore loans that have escrow are typically more valuable. However, there are situations, for example, during COVID where the SOFR curve, which is what we use for an earnings rate, fell below 2%. And for example, loans in California have a 2% interest on escrow requirement. So in that case, when the interest on escrow paid to the borrower is greater than the earnings rate, you would actually have a negative float assumption for the escrow dollars. And then the last assumption, as I mentioned earlier, discount rates. At Willery Winn, we use a discounted cash flow method to value servicing rights. This is essentially the yield an investor would expect to earn on their investment, and it discounts the net cash flows back to present value at this rate. So just a few summarizing items on what I just went over. Again, servicing fees are based on the remaining principal balance. When thinking about cost assumptions, we use dollar cost assumptions. The idea behind this is using a basis point assumption, you're implying that as a loan pays down, the cost to service that loan decreases, which is inherently untrue. It would likely cost the same amount to service a $500,000 loan as it would a $750,000 loan, for example. And yeah, the last two bullets I think we covered in detail. So Eric likes to joke, this is our popularity graph in blue specifically. So I'll focus on 2020. Hold on, not highlighter, laser pointer, there we go. In 2020, when mortgage rates hit historic all-time lows, you can see prepayment speeds peaked. Over here we have PSA, the rough conversion from PSA to CPR, which is more commonly known, is about a 6% conversion. This is a $175,000 30-year loan with a 4.25% interest rate. So even when rates fell, below 3% in 2020, prepayment expectations were pretty high on a 4.25 loan, and therefore values fell to about 60 basis points. Since then, we've even seen rates fluctuate. Looking at March 2025, in a 6 to 7% fluctuating interest rate, The prepayment expectation on a 4 1/4 loan falls dramatically below 100 PSA, and therefore the value on that loan increased significantly as compared to where it would have been at in 2020, north of 1.35%. All right, so when looking at the different valuation inputs, there can be a range that is still reasonable from a market perspective. There should be differences between Fannie Freddie agency loans and Ginnie Mae loans, for example. So you can see here, agency loans have lower ancillary income expectations. However, they have lower cost assumptions as well and lower discount rates. So even between conventional mortgages, agency loans versus Ginnie Mae, you can see values vary due to these input assumptions. So as I mentioned earlier, prepayment speeds have the biggest impact on servicing rights value. This is a $250,000 30-year loan at a current interest rate of 6.75%. When we ran base case scenario, the expected prepayment speed on this loan was 12.2%. We assume a $70 cost and a 1.82% delinquency rate with 16 basis points as the default rate. And the discount rate was 9.75%. So just adding a little context in terms of shocking those assumptions by 30%, you can see when prepayment speeds increase 30%, 11 basis points of value is lost, which is the biggest change across the 4 assumptions that we analyzed here. Following prepayment speeds is discount rates. Nearly 10 basis points of value was lost with an increase of 30% in that assumption. And as I continue to mention, given the low delinquency rate environment, increasing that assumption by 30% resulted in nearly no change to the value of the asset. So looking at that same loan, we look at what are the expectations if rates are to fall as low as 200 basis points or if they're to rise as much as 200 basis points. And this reflects the negative convexity that servicing rights have. So in the down 200 shock, 58 basis points of value is lost. However, in the up 200 shock, only 19 basis points of value is gained. As rates fall, prepayment expectations increase much more dramatically, and the discount rate will hit a floor in our model. As rates rise, prepayment speeds will decrease, but at a less dramatic rate. And so the discount rate increasing suppresses the increase in value. All right, this graph shows the change in prepayment speeds over time and the impact on MSR values. So in 2020, when prepayment speeds peaked, MSR values were significantly compressed. But then by 2022, when rates increased, prepayment speeds subsided and servicing values rebounded. The orange represents loans less than 3.5%, and the gray represents loans greater than 4.5%. So you can see that those low interest rate loans that were originated in 2020, 2021, the value on those loans has increased and held pretty steady as compared to the higher interest rate loans, especially with the recent volatility that we've seen in rates. A borrower could originate a loan at 7.5%, and a month later rates could fall to 6 3/4. That incentivizes that borrower to refi. So because of the volatility in rates and the risk that higher interest rate loans have if rates do fall, we often caution our clients against being too aggressive when recording the fair value of those higher interest rate MSRs. Next, we'll take a look at the two different accounting methods used to record servicing rights. So earlier I mentioned the amortization method, but here we'll start by taking a look at the fair value method. So under fair value, the value is determined at each reporting period, typically quarterly, and the asset is adjusted to its fair value at each period. The difference is then taken into income or expense for that respective period. And hedging a servicing portfolio can be difficult, but it allows, under the fair value method, it allows the institution's debits and credits to minimize earnings volatility. Institutions that don't hedge under fair value will experience more earnings volatility, which is why the majority of our clients will elect the amortization methods. Both methods are completely acceptable under GAAP. So with the amortization method, the MSR is amortized in proportion and over the period of the net servicing income. So the technically correct way under GAAP is level yield. However, we do see other ways, for example, straight line or sum of years digits. And then the asset is then periodically tested for impairment. The materiality of the asset may impact the frequency of the impairment test, whether it's quarterly, semi-annually, annually, or even less frequently. We update amortization rates for our clients based on material changes in level yield cash flows, often corresponding to changes in rates, which impact prepayment speeds. So faster amortization, especially on higher interest rate loans as prepayments rise, and vice versa. And an institution that has elected the the amortization method can make a one-time election at the beginning of its fiscal year to fair value, but once fair value is elected, that is a permanent decision. So when thinking about impairment, it is measured at the loan level, but under GAAP, you would break the portfolio down based on predominant risk characteristics, which we'll take a look at in a second. There is a difference between temporary impairment through an allowance and permanent impairment, which would be a direct write-off. So especially in 2020 and 2021, the dramatic decrease in interest rates did result in permanent impairment for some of our clients in their higher interest rate loans. Given that the value was not expected to recover, many of those clients experienced high volumes of refinance. So really the loans moved from the higher interest rate band into the lower interest rate band, but they would have had remaining book value in the greater than bucket, resulting in impairment. This is a snapshot from September 2024. I used this timeline because we saw rates dip at September 30th, 2024. They did recover by December, so many of our clients that showed impairment in high interest rate loans at September were able to reverse that by the end of the year. As I mentioned, we break the portfolio down based on predominant risk characteristics to test the asset for impairment. The characteristics that we focus on here are term and interest rate. Another thing I'll mention is these are all residential mortgages. So if we were valuing commercial loans, ag loans, we would value them completely separately from residential mortgages, and they would have their own impairment test. Once the characteristics for an impairment test are set, they should remain consistent moving forward in time. So not adjusting the interest rate bands or switching methods completely. Sometimes maybe a one-time change is warranted, but we certainly don't advise our clients to be making changes period over period. All right, so the kind of macro hedge to manage runoff risk of mortgage servicing rights is as rates rise, originations will slow, prepayment speeds slow, and therefore MSR values increase. Vice versa, as rates fall, prepayment speeds will increase and MSR values will decrease, but hopefully institutions are able to pick up that origination volume and that those fees help to offset the decline in the MSR value. As mentioned, institutions can hedge with positive convexity instruments, and those under the amortization method should just make sure that they're utilizing appropriate methodology in order to avoid an impairment situation. So we do have a basis roll forward example. For the sake of time, I am going to skip this. However, if anyone is interested in seeing our roll forward file, how we calculate amortization and apply it to basis values, please don't hesitate to reach out and I'd be happy to walk you through it on an individual basis.
It's basically simplified day two accounting.
Okay, I'm also going to breeze through these slides. So FFIEC call reporting requirements, these just show where they would be recorded. This is for both the 41 and the 051 call report related to the servicing rights asset, the fair value, servicing fee income, and if there's a gain or loss on the sale of the loans, as new loans are sold, you would record the gain. If you are reporting on FFIEC 041, there would be additional schedules for RCP if activities exceed the 10 million threshold and meet the requirements for that schedule. Additionally, if fair value accounting is elected, there should be additional reporting on Schedule RCQ. And we mentioned briefly the Federal Home Loan Bank program. With credit enhanced products, there's additional reporting for those items as well, specifically on Schedule RCR for balance sheet exposures and limited recourse loans. A little different on the FFIEC 051, they utilize Schedule SU as opposed to Schedules P and Q. Again, meeting certain thresholds, and depending on the activity of the institution, they would want to report on RCR, etc. All right, with that, we will launch the next poll question, and we will keep an eye out for questions.
All right, we're gonna go ahead and close the poll and we will share the results. So for those 13 of you that have clients that have not recorded an MSR asset, feel free to send them our way. We can help them with that. It's cheap capital from their perspective. So shameless plug, sorry.
Okay.
Did we have any questions?
Oh, yep.
Yeah, one question.
Or I can read it. What impacts on the market would you anticipate if Fannie Mae and Freddie Mac are brought private?
That is a very interesting question. You get an A+. So I'm old enough that I remember when Fannie and Freddie were private. So pre-takeover, what happened is they became wards of the state as a result of the financial crisis, from the originations we described earlier. And so what I've seen over time, interestingly, is that the G fees, the guarantee fees, have actually widened as they are essentially controlled by Treasury, right? And so there's two camps. One camp would say, if we don't have the full faith and credit of the U.S. government or an backing the securities, the rates could rise. There's some part of me that thinks that the G fees might actually drop under the old arrangement, where it's quasi public or quasi governmental. I think at the end of the day, what you'll see is you'll see them privatized, and you'll see a federal government backstop. So the implied full faith and credit guarantee that we saw pre-mortgage crisis, kind of back in the good old days, I think that'll become explicit, and I don't think you'll see much change in rates on the increase side. I actually think you might see a drop.
All right, thank you, Madeline, for your question. Okay, so next we will briefly touch on the SBA 7A marketplace. In addition to residential mortgages, we also value SBA 7A loans through gain on sale calculations and full portfolio valuations for the asset. So similar to residential mortgages, we'll just take a look at the marketplace here, looking at historic SBA loan approvals. 2025 is annualized based off of data through June 2nd, which the majority of those originations were under the previous administration. We'll touch on a few changes that the SBA is experiencing right now under the new administration, which could hamper these growth projections. But as you can see, 2025 is projected on an annualized basis to exceed the boom that we saw in 2021 coming out of the COVID pandemic. And these are specifically 7A loan approvals, so it would not include anything from the PPP program. But even with the 2021 boom, you can see since then, SBA loan approvals have remained above 2019-2020 levels. Here, looking at the top originators for SBA 7A loans, probably not surprising, but a lot of banks on this list, I think almost all banks. Live Oak Bank continues to, they recently took over the #1 rank in 2025 in terms of total originations, nearly $2 billion, surpassing New Tech that had $2 billion in 2024, but has since decreased to over $1.6 billion. One thing to note here too, not included on this slide, but New Tech has significantly higher loan count compared to Live Oak. The average loan size for New Tech is about $500,000, whereas Live Oak is greater than $1 million. And as I mentioned, there are some agency changes occurring in 2025. So in March, the SBA announced a 43% workforce reduction, eliminating approximately 2,700 positions. This returned staffing levels to pre-pandemic levels. Later on in May, the Senate and House Small Business Committees introduced a proposed bill for manufacturers, which proposes to increase the SBA loan cap to $10 million specifically for that industry. And then lastly, just a note that in late March, the SBA actually updated its fee schedule. Typically, these are approved for a full fiscal year, October through September. However, in March with the update, anything approved after March 27th through September 30th will be under the new fee schedule. And we've included a link here to our May 5th post, which elaborates on these bullet points in a little more detail, including the specific fees being charged. Do we have another polling question at this point? Okay.
We do. We're gonna sneak them all in.
Second to last polling question, I believe.
Right, we will close the poll in just a second. All right. Okay.
All right, so lastly, and hopefully pretty quickly here, we'll just touch on SBA gain on sale calculations. They, similar to residential mortgages, we use discounted cash flow analyses. Specifically with gain on sale calculations, the guaranteed portion is sold on the secondary market, and there will be a premium on that portion sold. Any premiums in excess of 10% are split 50-50 with the SBA. It's noted that service fees on SBA loans are almost exclusively 1%. The SBA made a rule that forced the service fee to be at 1% to prohibit institutions from charging different service fees in order to avoid sharing any premiums in excess of 10%. Based on a study done by the National Association of Government Guaranteed Lenders, NAGL, it was determined that 40 basis points is the industry cost for SBA loans. Therefore, the 1% service fee net the 40 basis point cost assumption results in a net 60 basis point revenue stream from the servicing rights. Again, similar to residential mortgages, we incorporate prepayment speed assumptions for the projected paydown of the loan. We also incorporate ancillary income and float, and the net cash flows are discounted back to present value using an internal rate of return. So when performing gain on sale calculations, we will take into account the premium on the guaranteed portion as well as the servicing asset, and we will calculate a relative fair value to determine the portion that is related to the discount. There are other ways to value the discount on retained portion, including a discounted cash flow methodology. Yeah.
That's generally used for clients that may have elected fair value on the retained portion. They may use a discounted cash flow, but otherwise the majority of clients are using the relative fair value calculation.
And then lastly, if there are any deferred origination costs or fees, those would be released proportionate to the portion sold, typically the guaranteed percent. Similarly, I've included here a link that references an accounting white paper that goes into more detail on our valuation methodology as well as the accounting and calculations related to the discount. So looking at this slide, this is really to show the different loan terms will result in different servicing assets. However, This impacts the discount on the retained portion for the relative fair value calculation. So longer term loans with higher servicing assets will have a higher discount, but we'll still see a net higher gain on sale. And this example shows that all else being equal, term, loan amount, etc., with different premiums. You can see the 15% premium, there is a portion shared back to the SBA, and that does impact the relative fair value calculation for the discount as well. So with a higher premium, you will have a higher discount, but again, your gain on sale is higher as well. And then this last slide just shows an example. This is a sample gain on sale summary that we would provide to our clients when performing gain on sale calculations. This helps reflect the release of the fees and costs deferred, as well as portion shared with the SBA in order to determine that reallocated gain on sale, incorporating the discount on the retained portion.
And now we'll launch our last poll.
And thank you for sticking with us. I know we've hit our time limit, but much appreciated.
We'll give you a few more seconds. And it looks like we do have a question.
The same question. Oh, no, there's one. I see.
What do you expect to happen to the market when Powell's term is over?
We're gonna duck.
Okay.
We're gonna duck.
Sorry, Cynthia. All right, we'll go ahead and end the poll. Okay.
All right, just some last few items. We do have a lot of resources available on our website. They're free to access. There's no gate, and we really pride ourselves on these resources. So please don't hesitate to go to our website and take a look at them. I've included a few specific links for the topics we've discussed today, as well as links to our loan servicing services page. And I've included here, Doug mentioned at the beginning, we offer, 4 primary business lines: CECL, ALM, M&A, and obviously today's topic, servicing rights. So if you have any immediate questions regarding our services, please do not hesitate to reach out to the appropriate contacts. And there will be a survey immediately following today's session. Again, we always appreciate any feedback you may have. A copy of this recording and the slide decks will be provided to all attendees, and CEP certificates will be provided next week.
Thank you.